Thank you, Dean. I guess it's quite an interesting opportunity, we believe. We are listed as a junior on the ASX and listed on the ASX in June this year. We have a focus on hard coking coal production, and we're actually a producing mine. We started mining in January this year, and we have operations in Queensland, focused in the centre of the Bowen Basin. So just to quickly run through these slides, and just to give you, I guess, a flavour, we're in booth 38, just down the road. So as I say, every photo you can see here is all existing infrastructure. The opportunity, we were originally a coking coal contractor for quite a few years, but last year we were able to acquire an operating asset that was highly overcapitalised during the boom, and then fell into financial distress, and we've been able to pick up an asset that was more than $1.3 billion spent on acquisition and upgrade. We picked this up for just on $30 million. So we have the mine operating and ramping up. So we are a junior, full exposure to coking coal. We have a little byproduct thermal coal, but high quality thermal coal, but 85% of our product is sold into the Asian hard coking coal market. We acquired the asset on the 8th of December. On the 24th of January, we started mining with 1 unit. We are using a more flexible board and pillar system, which is a multiple small units of mining units rather than the big traditional longwalls, which are quite boom bust. So we've got a lot of risk diversification in having now we have 4 operating units underground. 3 of them are in a development style that push the tunnels forward and do all the roof bolting. And the 4th one can come and extract the ribs, the sides and the floor. We have a 4.3 metre seam. We're taking up to 3 metres on the first pass and coming back with this sumping unit, high productivity on the way out, taking floor and the walls. We've upgraded the rail loop. We had a number of rail restrictions, even though it was a full capacity loop. It's an 18 kilometre loop. We spent about $2 million to get that back to full operating status. We've got 2 major coal offtake agreements with a large US trading company, Xcoal, who are also a very strong supporter and now have 16% of the company as well, and a Chinese steel mill that are through their trading arm and also very strong supporters. We, as I said, recently listed through an $18 million IPO in June. So we've been kicking a lot of goals in the last 9 months since we started production, and we're just about to ramp up from around a 40,000 tonne per annum rate, but over the next few weeks towards a 65 to 70 or even higher 80,000 tonne rate over the next couple of weeks, with some additional trucks that are going underground this week. Just some basic stats. 385 million shares. We've just had a small additional raising just to give us a bit more working capital. We had a number of delays on some of the smaller machines, particularly the electric trucks called shuttle cars, and some minor approvals which have delayed us through between 4 to 6 weeks. But now we've had a fully supported off-market raising at actually a small premium to the market last week. And we've got, call it on current market cap, about 100 million market cap. We're highly undervalued. The market is waiting to see us to start to get to a cash flow positive position, which will be very soon now, particularly with these extra trucks going underground this week. We've got Cornerstone, the US trading company, at 16%, the steel mill at just under 12%, and I'm actually there at just under 9%. So it's quite an open register, but still strongly supported by the board. So just a number of very experienced and qualified directors. We've got, in addition to this operating mine and the asset, it's almost an infrastructure play. There's a central large processing plant with more than 3.5 million tonnes capacity. We'll be currently running the Cook Colliery. We will be at a very soon at a 1 million tonne rate. Build that next year to a 2 million tonne rate. But then we have, and that should provide very strong cash flows. Within 2 years, there's a separate project called Cook North, which is a potential open cut and future underground on the same tenement within 2 kilometres of the existing asset. And then there's this Minyango project, which is another enormous greenfields opportunity, which is all of these projects have mining licenses and environmental authorities and are all within 10 kilometres of an infrastructure that has capacity of more than 3.5 million tonnes per annum. So there's very little money, if not to be spent on the main infrastructure. There'll be some individual money spent on each project. In addition to this capacity, one thing I forgot to admit, because we've got so much latent capacity already, we've now already entered into a 1 million tonne per annum toll washing agreement with a neighbouring mine, which should generate more than $5 or $6 a tonne of straight profit using existing infrastructure. So just in summary, of the three main projects, there's also a further longer term project called Wongai. We've got in excess of 700 plus million tonnes of what's predominantly coking coal, hard or even premium coking coal, with some byproduct thermal coal, and all with existing infrastructure, all apart from the Wongai project, fully permitted, and we also have an operating asset. So just as a quick summary where it is, this is all existing rail corridor to the main port of Gladstone. We already have an allocation of a quadrant at the old Gladstone port, which is a much smaller fee of only about $5 a tonne compared to the Wiggins Island terminal, which is greater than 23. We have existing rail agreements now, mostly ad hoc, but we'll start converting those to longer term offtakes. And we also, like I said, we've got probably more than $600 million of infrastructure. If you were to build an 18-kilometre rail loop, a tailings dam, a 3.5 million tonne per annum process plant, and all the electricity and water that's needed, the process plant itself has got to be worth more than 600 million Australian dollars. And we've got all of this for $30 million, including two deals between the liquidator and Glencore, who owned the head lease. And they had a marketing agreement, which we've also agreed to buy out. So just all of this is all existing infrastructure. And we've just really restarted the mine. It was on care and maintenance for 12 months. So we picked this asset, a distressed asset up that was, as I said, highly capitalised in the bottom of the market. And now that, quite interestingly, the market has really taken off, we sell not at the premium price of coking coal, we sell at the second tier price, which is currently over 188. It's jumped to 188 US, and we get a bit of a discount to that. So currently we're getting more than 240 Aussie dollars per tonne for our coking coal. All of this infrastructure needs no money to expand for operations for the next 2 years. So just simply, as I said, we operate with 4 separate areas in the mine, and these are smaller, what they call continuous miners with electric trucks or shuttle cars. So our mining style is not like the big long walls where you put a couple of tunnels in and extract across a maybe 200 metre wide face. We operate and put in a number of small tunnels with very large pillars. And this is so we would be mining from the top of the page down to the south and open up and fully bolt the roof. It's all very stable, very high factors of safety with very large pillars. Then we have a secondary phase with our sumping machine. Basically, it mines pockets out of the ribs, and as I said, in some places up to a metre of coal in the floor with no bolting. So all it is doing is just cutting coal. And so the red area is our secondary extraction, which we're currently in the middle of this now. So this is between the 3 developing and the 1 sumping is what jumps our productivity. And it's only just kicked in with full approvals, and the additional trucks will be this week. So a little late, but we're getting very close now to a fully cash flow position. So we've currently produced since January. It was initially 1 unit, but slowly built up to 4. Just over 260,000 tonnes of coal we've already mined. We've got quite high product. We've already sold quite a bit of coal, and although this plant yield is only 81%, we've actually been taking a lot of old remnant coal around the wash plant. But what we're getting for the coal, clean coal coming out of the mine, is in excess of 85%, and 85% of that's coking coal. And the rest is a byproduct. So this is just the further Greenfields project, which is about 10 just 15 kilometres north of where we are. It's actually on the other side of the process plant in the town of Blackwater. Already this red area is approved, and we've got additional areas what will be granted mining development leases in the short term. And this is just a longer term project in a completely different basin, but that's not our main game at the moment. So just very simply, a huge demand, Australian export for coking coal. We have 17% of total world production out of Queensland. 54% of that is actually seaborne trade is from Australia, and that goes to all major Asian economies. For just even the standard car, call it of 1 tonne car, there's 800 kilograms of coking coal needed for that car. So this is not a replacement for renewables. It is a highly in-demand commodity for growth areas, particularly in India and Southeast Asia, as well as just providing high-quality coal to China. And just quite strong future growth, which most predominantly will come out of Australia, in excess of 40 million tonnes over the next three to 4 years. So we want to grow this business to be at least a 5 million tonne per annum future over the next 3 to 4 years, and we have all of the assets with all approvals ready to go. So that's, basically summary of where we're at. Thank you.
Thank you very much.
All right.